Here's what you may have missed last week in markets. Before we dive in, make sure to follow our page to stay up to date with the latest market news and financial planning tips here in Canada. Last week was a bit of a mixed bag for markets, with the week closing relatively flat. The Dow actually hit a brand new all-time high last week, while tech had a rockier ride. Markets remain up about 10% on average year to date. Tensions between the US and Iran escalated again over the weekend, with both sides trading strikes and Iran declaring the Strait of Hormuz, a major oil shipping route, closed. The US says shipping is still moving through. This is the same story we've seen a few times this year. A flare-up, a market flinch, and then a de-escalation. Markets don't react to the same news twice, so even though tensions are rising, we are actually seeing markets react less to the news than they previously did. Markets are slightly down to start the week, and oil prices ticked back up slightly, close to $80 a barrel. Even oil markets themselves, however, have started to shrug this off faster than they used to, a sign that investors are getting much more comfortable separating scary headlines from actual economic impact. The bigger story for markets was actually in the semiconductor space. SK Hynix, a major memory chip maker, had a huge debut on the Nasdaq Friday. Shares popped off as much as 13% on its first day of trading. Then, almost immediately, the stock tumbled roughly 17% back home in South Korea overnight, its steepest one-day drop ever, dragging the whole Korean stock market down about 9% and triggering a trading halt. Nothing new actually happened. No bad news came out. It looks more like investors just taking profits after a huge run-up in AI-related stocks. This is a great real-time example of something we actually talk about a lot. When a stock or sector runs up fast on excitement, it can come back down just as fast with nothing more than a mood shift. We saw something similar happen with SpaceX's IPO just a month ago. Since its initial week of excitement, SpaceX stock has also dropped and is now trading at $140, close to its offering price of $135. It's exactly why we don't chase hot trends. We build portfolios around companies and sectors with staying power, not just momentum. Earnings continue to be the real driver. Here's the headline that actually matters most. This week kicks off Q2 earnings season, and it's shaping up to be one of the strongest in years. Companies are expected to post 20% plus profit growth for a second straight quarter. Some of the biggest names in banking, like JP Morgan, Goldman Sachs, Citigroup, Wells Fargo, Bank of America, all report this week, along with Netflix, Johnson & Johnson, and United Health. Taiwan Semiconductors already reported over the weekend and beat expectations, with revenue up 36% year over year on strong AI chip demand, a good early sign for the sector. At the end of the day, it's earnings, not war headlines, not one volatile stock that drives markets over the long run. And right now, the earnings picture looks genuinely healthy. The new Fed Chair Kevin Warsh testifies before Congress this week, for the first time in the role, and we'll get fresh U.S. inflation data midweek as well. The Fed's own June meeting notes showed some officials are still worried about inflation running a bit hot, partly due to tariffs and higher energy prices from the Iran conflict. The Fed is still very data dependent, meaning each new inflation or jobs report can shift what they do next. That creates some short-term back and forth in markets, but it's a normal part of this stage of the market cycle, not a red flag. So what does this mean for your portfolio? Yes, there was a lot of noise last week. A war headline, a single stock's wild swing, a cautious Fed, all of them real, but none of it changes the bigger picture just yet. Markets have consistently proven that they care more about earnings and interest rates than about any single headline, and both of those are trending in a reasonably healthy direction right now. For anyone in an actively managed portfolio, this is exactly the kind of environment we plan for. We diversify across sectors so no one single story, an SK Hynix, an oil spike, can do outsized damage, and we lean into quality earnings-backed companies rather than hype. History backs this up too. Markets have recovered from geopolitical shocks far faster than most people expect, often within weeks rather than months. Volatile weeks like this are uncomfortable to watch, but they're also a normal part of investing. And historically, staying invested through them has paid off far more than trying to time around them. If any of this, the headlines, the chip stock whiplash, or just wondering whether your portfolio is positioned for this kind of environment, has you asking questions, this is exactly what a second opinion is for. Reach out and let's book a time to talk through your portfolio and your strategy together.